听见资本本期视频为您带来的是摩根大通在3月27日录制的有关黄金市场话题的内容。黄金价格最近突破3000美元，成了全球热议的话题。这期节目带你走进一场深度演讲，聊聊黄金从1971年脱离金本位之后，怎么用了38年才破1000美元，又在12年后翻倍到2000美元，到现在不到5年就飙到3000美元，从2500美元到3000美元，只花了200天，比之前每500美元的增长快得多。演讲者大胆预测4000美元可能不远了，但这背后藏着哪些推动力和风险？首先，黄金价格的上涨离不开实际收益率、通胀预期和地缘政治的合力。过去1970年代通胀狂飙，黄金涨了8倍，2000年后实际收益率成了主角。但2022年以来，剧情变了，新兴市场央行疯狂买黄金，对冲美元风险。俄乌冲突后，俄罗斯资产被冻结，各国开始反思美元主导的金融秩序，黄金成了避险新宠。社交媒体上有人看好黄金保值，有人却担心涨势难续。毕竟开采成本上升，供应跟不上需求，价格还能冲多久？这场对话不只分析走势，还提醒大家投资黄金得谨慎。4000美元听起来诱人，但收益递减和市场波动不是开玩笑。全球局势动荡，央行囤金热潮，黄金市场正迎来新变局。你觉得黄金还能火多久？欢迎留言发表你的看法。接下来是英文会议的全部内容。如果您需要我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Hello, and welcome to another episode of At Any Rate. I'm your host, Natasha Kanova, and I head JP Morgan Global Commodities Research. Today, we would like to discuss gold prices and whether $4,000 price is in the cards. After the U.S. abandoned the gold standard in 1971, it took about 38 years for gold to surpass the first 1,000 mark in March 2008 during the global financial crisis. The 2,000 milestone was reached in August 2020 amid the economic uncertainty of the COVID pandemic, marking a 12-year journey to double the value from 1,000. The timeline has since accelerated, with less than 5 years needed to reach the third milestone. On March 14, 2025, spot gold prices broke through the 3,000 barrier, settling at an all-time high of $3,001. The swift ascent from 2,500 to 3,000 occurred in just 200 days, significantly faster than previous 500 increments, which have averaged over 1,700 days. With each $1,000 phase taking about 2/3 less time than the previous one, and considering the law of diminishing returns alongside investors' attraction for round numbers, could the 4,000 mark be just around the corner? Over the past 7 years, we have made 3 strategic calls on gold, beginning with a long position in February 2018, closing it in July 2020, and reissuing a new bullish call in November 2022, marking it as a sole structurally bullish call within the commodity sector. Heading into 2025, gold remained our top bullish pick for a third consecutive year in a row. Our original thesis suggested that despite the noticeable shift in gold relationship with the U.S. 10-year real yields, in 2022, the inverse correlation, although more sporadic and much weakened, continued to persist. We argued that following the large move higher in real yields in 2022, they should stabilize over the coming years, which would be bullish for gold prices. In short, we maintained the real yields would remain the primary and dominant driver of gold prices. But by mid-2023, it became clear that gold's fundamental backdrop has shifted in a structural way. Gold's value has traditionally not been based on its practical utility like copper or oil, nor on its capacity to generate cash flows like bonds or dividend-paying stocks. Unlike natural gas, for example, gold prices are not influenced by immediate supply and demand factors. Instead, its worth is derived from its ability to act as an ultimate shock absorber, providing protection against geopolitical upheavals, inflation, and as a non-yielding asset, lower interest rates. In 1971, following the dissolution of the Bretton Woods system, President Nixon closed the U.S. gold window, effectively removing the dollar from the gold standard pack and allowing the dollar-denominated gold prices to fluctuate freely. However, a multi-decade prohibition on U.S. public gold bullion ownership persisted until 1974. Over the ensuing 50 years, 2 distinct long-term gold pricing regimes have emerged. It appears that since 2022, a new regime has begun to take shape. So the first regime lasted through 1970s, through the late 1990s. At that time, gold prices were primarily influenced by the long-term fluctuations and demand for bullion as an inflation hedge, given its nearly fixed supply. The sharp rise in expected inflation coincided with an eightfold rally in real gold prices through the 1970s. However, the Volcker disinflation in the early 1980s brought about a sharp decrease in both expected long-term inflation and gold prices. Inflation expectations continued to decline steadily through the late 1990s, with gold prices largely mirroring the fall. Yet from 2000 through 2021, survey-based 10-year inflation expectations remained largely anchored between 2% and 2.5%, while real gold prices increased significantly, clearly indicating the emergence of a new primary pricing driver around the turn of the millennium. Over much of the last 2 decades, the relatively static long-term survey-based inflation expectations, gold's primary pricing drivers shifted to U.S. real yields in that period. The logic underpinning this relationship is the competition between the two risk-free assets, gold and longer-dated U.S. Treasuries. Physical gold, being a yieldless, risk-free asset, becomes less attractive when risk-free real Treasury yields rise, as this increases the opportunity cost of holding gold compared to Treasuries. Conversely, when real Treasury yields fall, gold becomes more appealing. Looking over the last 2 decades, gold has typically exhibited the strongest inverse relationship with the 10-year U.S. real Treasury yield. There was little consistent inverse call movement between gold and real yields until around 2006, when the growth in physical-backed ETFs, which were launched in 2003, began to accelerate, expanding the investment avenues for gold ownership. For example, starting from 2006 to 2022, U.S. real yields accounted for nearly 90% of the valuation in the U.S. dollar gold price, with a relationship of 1 basis point move in the U.S. 10-year real yields consistently corresponding to an inverse change of about $3 in the gold prices. However, since the end of the first quarter of 2022, this beta has more than halved, resulting in an inverse reaction of around $1.40 of gold for every basis point move in the U.S. 10-year real yields. Rather than a complete decoupling, the slope of the relationship between these two variables has both diminished and fluctuated dramatically at times since the start of 2022. The breakdown in the relationship has kept gold prices remarkably resilient, even as real yields have rebased higher. For example, since Russia's invasion of Ukraine, the price of gold has surged by nearly 60%, despite a stronger U.S. dollar and 254 basis points higher U.S. real 10-year Treasury yields. Moreover, volumes of the giant U.S. GOD ETF had been declining until mid-2024, as U.S. investors seemingly were selling their gold holdings despite the surge in the gold price. So what that means is that heralded the beginning of a third regime in the gold pricing that started in the first quarter of 2022 and it's lasting through now. We believe that freezing of Russia's foreign assets and the surge in gold buying by EM central banks and consumers became the main driving forces during that regime. So throughout the early 2000s, central banks were consistent net sellers of gold, but this trend reversed in 2009 when they became consistent net purchases. However, since the start of the Russia-Ukraine war, central banks, which had previously been highly price-sensitive buyers of relatively modest gold volumes over the past 15 years, have evolved into entirely price-insensitive super buyers of gold. The trend has been underway since 2014, so it's not something that started now when the first round of sanctions was introduced after Russia's annexation of Crimea, and Russia, to diversify away from U.S. treasuries, began shifting some of its FX reserves into gold. The buying activity accelerated in 2022 when, within days of Russia's invasion of Ukraine in February 2022, the U.S. and its allies blocked around $300 billion of sovereign Russian FX and gold reserves held in the West, upending the global financial order that had prevailed for the past 50 years. This post-Bretton Woods financial order was marked by several key characteristics, including the U.S. dollar serving as the dominant currency in international trade and finance, the U.S. consistently running current account deficits, enabling the rest of the world to earn the U.S. dollars needed to fund its trade, countries with current account surpluses placing their excess U.S. dollars in the U.S. treasuries for safekeeping, thus funding the U.S. budget deficits, The rule of law, ensuring that foreign holders of U.S. debt securities are treated fairly and comparably to domestic investors, an independent Federal Reserve standing ready to act as lender of last resort, guaranteeing the market's liquidity and stability, strong U.S. growth that reassured the world that America could stand behind its obligation, and an open world trading system to which the U.S. and its partners were committed, complemented by steadfast geopolitical alliances. For half a century, this financial order worked really well, affording the U.S. the unique advantage of sustaining this kind of twin deficits that would have been inconceivable under the earlier gold-centered system. However, given the centrality of U.S. dollar in the world's economy, even before Russia's attack on Ukraine and the subsequent sanctions on Russian entities, America began to increasingly rely on economic tools like sanctions as a means of foreign policy. For example, the number of OFAC sanctions designations, including companies, individuals, vessels, and aircrafts, rose exponentially from about 912 in 2000 to 9,421 in 2021 and over 18,000 presently. Today, the U.S. imposes sanctions at a rate 3 times higher than any other country, targeting a third of all nations with various financial penalties. Importantly, the sequestration of Russian funds in early 2022 was carried out in cooperation with America's allies, given that most of the frozen Russian assets are held in European central banks, primarily in Germany, France, and notably Belgium, where more than half of all Russian frozen assets are managed by the depository and clearinghouse Euroclear. In contrast, only about 5 billion of these assets are allocated in the United States. This left Russia few alternatives to the dollar, euro, and the Swiss franc for use in international payments, prompting the country to begin shifting its reserves into gold. Russia's gold holdings more than doubled since 2014 to 2,333 tons as of February of this year, and the share of gold in Russia's foreign exchange reserves rose to roughly 30%, up from 10% in early 2014. The sanctions imposed on Russia in 2022 heightened the incentive for countries to hedge their foreign reserve holdings by diversifying away from the dollar, driven by the possibility that Russia's dollar assets could not only be frozen but also confiscated. That was particularly concerning given Russia's liability for nearly $500 billion of war damages, setting a precedent for what other countries might face in similar circumstances. So those nations that with reasons to reconsider their investment strategy have begun to do so in 2022. Just by number, historically, central banks have purchased around 400 tons of gold annually. However, in 2022, they bought a net of 1,080 tons of gold, more than 2 times the annual average of the previous 5 years and the highest annual demand growth on record going back to 1950. Central bank holdings buying in 2023 built on the prior record year, totaling another 1,051 tons, the second highest on record, and the pace unprecedented in modern history, followed by another 1,045 tons in 2024. 2025 started where 2024 ended, with central banks buying still more. So to be sure, the number of countries looking for alternatives to the US dollar to diversify their reserves might increase beyond the usual ones. Amid President Trump's successful standoff with Colombia in January of this year, which went largely unnoticed, was the threat of imposing financial sanctions on a close US ally, sanctions previously reserved for US adversaries such as Iran and North Korea. Overall, it is hard to quantify the exact impact of central bank purchases on gold prices. Historically, given the very large above-ground stocks of gold, central bank activity and other physical demand have not exerted the same direct and lasting impact on gold prices as macroeconomic factors like yields and inflation. Additionally, given their price sensitivity, central banks have traditionally served to provide a floor for the gold prices rather than acting as a catalyst for a bull run. This impetus for such rallies has typically been driven by investor demand in futures markets, followed by the influence of ETFs. But as we believe, things have changed since the first quarter of 2022, when quarterly central bank purchases rose from a relatively steady average of around 120 tons in the previous 5 years to an average of 280 tons per quarter in the subsequent quarters. Despite investors selling gold on financial markets via futures and options and ETFs, total net gold demand stepped up to an average of about 570 tons per quarter since the second quarter of 2022, as central banks and investors have increased physical purchases. This demand has driven gold's initial price resilience even amid rising U.S. real yields and has contributed to a subsequent price surge as investors have returned to the market. More buying is likely to come as U.S. strategically departs from the traditional global leadership role that the U.S. has held since the Second World War, shifting towards an American-first approach in foreign policy, emphasizing pragmatism and transactional diplomacy. The strategic recalibration of America's role on the world stage is evident in President Trump's early actions. Within just 2 months in office, Trump has helped secure a ceasefire and hostage deal in Gaza and has begun negotiating a peace agreement with Russia. Yet, in a move that appends traditional American foreign policy, President Trump has strengthened the U.S. relationship with Europe, called into question Washington's commitment to NATO, withdrew the U.S. from key United Nations institutions, and initiated a global tariff war. Breaking taboos, President Trump has signaled that the U.S. might challenge a central tenet of the post-war global order, prohibition against territorial expansion at the expense of other sovereign entities, by asserting a sphere of American influence that extends to Greenland, with its minerals and strategic position in the Arctic, as well as to Canada and Panama. Amidst this shift, one notable casualty is the nuclear non-proliferation movement, as U.S. allies contemplate the ramifications of a potential withdrawal of the U.S. nuclear shield, while other nations increasingly recognize that in a world fraught with geopolitical tensions and unstable power dynamics, nuclear weapons offer a significant measure of security. Furthermore, the Trump administration foreign policy has injected deep uncertainty into China's timeline around Taiwan. So we believe that to meet this increased demand for gold, a structural response from the supply side is necessary. Traditionally, with large above-ground stocks of gold acting as a pool of supply, gold prices have been largely determined by the relative strengths of demand. However, to meet this increased demand in gold, a structural response from the supply side is necessary, which so far has been constrained. The problem for the gold market is that it's just not that big. Specifically, about 200,000 tons of gold have been mined throughout the human history, enough to cover a soccer field to a depth of just 1 meter. Most of this gold remains with us today, and for example, one can view the storied gold of ancient Troy at the Pushkin Museum in Moscow. World's gold production has largely stagnated since 2018, facing ongoing challenges like declining ore grades, higher extraction costs, and tightening environmental and regulatory standards. Scrap supply, which involves recycling gold from electronics, jewelry, and other sources, tends to fluctuate with gold prices. So when prices rise, more gold is recycled, bolstering supply, whereas lower prices might slow the rate of scrap collection. But so far, what we're observing since 2022, despite rapidly increasing gold prices, growth in supply has been relatively modest. Thank you all for listening to the Commodities Edition and JP Morgan's At Any Rate podcast. We look forward to continue the conversation next week. This communication is provided for information purposes only. Please refer to JP Morgan research reports related to its content for more information, including important disclosures. 2025, JP Morgan Chase & Company, all rights reserved. This episode was recorded on March 28, 2025.